Good afternoon, ladies and gentlemen. Apologies, this will be in English. My Russian is tiny. Yeah? What I'm going to try and take you through for the next 25 minutes or so, just checking out, is Wood Mackenzie's view on the megatrends that are affecting global oil, global refining and chemicals. So firstly, I'd like to thank Global Business Club for the invitation to this inaugural event. It looks like it's going to be a fascinating session, fascinating conference, and we're delighted to be here. The agenda that I've got is an oil and gas outlook. We'll then go through refining, chemicals, and draw some key conclusions. If we look at near term, our outlook for global oil price is actually that it will stay relatively weak and relatively low. The chart on the left-hand side shows our view of annual oil demand growth on a global level. And what we have is oil demand growing at about 1.3 million barrels a day year on year. China is relatively stable, India growing, Europe moves to decline, the US continues to grow. But it's important to note that some of that US growth is actually associated with petrochemical projects that are being brought online. So a lot of the ethane crackers being commissioned in 2017 and 2018 are responsible for that oil demand growth. So it just highlights the point that oil demand often includes things that come from gas streams, such as ethane. So we have oil demand growing. If we look at oil supply, we see much stronger growth in oil supply, largely driven by what is happening in the US. If you look at the chart on the right-hand side, dots show global supply. Our expectation is that in 2018, even if OPEC continues its cuts, non-OPEC continues its cuts, global oil supply will go up and may well go up more than global oil demand, which suggests oil price needs to come down. This is virtually all driven by developments of US tight oil, primarily in West Texas, primarily in the Permian. So US tight oil is continuing to grow strongly, somewhere between 700,000 barrels a day, 1 million barrels a day, even at current prices. So in the near term, global oil demand remains, global oil prices remain, we think they're going to remain low. If we go to the long term, we have a similar view to what's just been presented, and actually the pace of global oil demand growth slows. Transportation hits a plateau and stops growing. The growth is from petrochemicals. The challenge with petrochemicals is we think half of that petrochemical feedstock will come from non-crude related sources. Ethane, NGLs from gas production, LPGs. So we're looking at a world where oil demand growth is going to slow. We don't have anything as aggressive as what we've shown in terms of oil demand will fall. We do not hit a peak. We have a conservative view of electric vehicles, but oil demand growth is certainly about to slow. We think oil prices over the next decade need to rise. So the chart on the left-hand side shows you the development of what we call supply gap. So the dark blue is global oil demand currently. The green is oil demand growth. That's quite small. The grey is ongoing production decline from operating fields outside OPEC. Crude oil production from existing fields at a global annual average level declines at 5% per year. So even if there was no oil demand, there is still the need for upstream projects to recover that production decline. So what we end up with is the red bar, which is over 20 million barrels a day, of new sources of oil that need to be developed in the next 10 years to satisfy demand growth. Chart on the right-hand side shows where that comes from. We believe we need more oil than is available from the US. We think US tight oil production hits a plateau, so there is a need for conventional projects. Those conventional projects are more expensive, and you can see the break-even bands go up. So we don't think current oil price levels are sustainable over the long term. Lots of uncertainties around the costs of projects, lots of uncertainties around how US tight oil production grows as we go forwards in time. Technology is improving, but they're drilling away from the best locations. And we have cost inflation. It's how those factors balance out. So this is our long-term oil price outlook. We get to about $65 in about 2020, so higher than where we are now. We get to something around 70, 75 by 2023, 2024. Then we hit a decline because we think lots and lots of conventional projects that are attractive in the $60 to $70 barrel range are developed. That drives prices down, and then by the late 2020s, we need to find more oil. Crude oil exploration budgets have been halved. Crude oil exploration has halved. That means we're increasing reliance on OPEC, which means prices we expect to rise again. If we look at one of the megatrends, we are expecting the US crude exports to exceed many of the OPEC countries. We're looking by 2022, 2023, US crude exports to be somewhere between 2 to 3 million barrels a day. US will be the largest liquids producer. It is not investing in its refining capacity. We're expecting US tight oil production to hit 12 million barrels a day, in which case we will have significant volumes exported. If we move to gas, our view is global natural gas prices will remain low for a long time. Significant capacity has been added in both the US and in Asia Pacific. Demand growth has stalled. We're looking at natural gas prices remaining very low for the next 6 to 7 years. After then, demand growth picks up, we require new projects. But we're looking at the US LNG plants competing with Russian pipeline gas into Europe, and that keeping prices low in Europe. For many years, Asia gas prices will also be low because they'll be linked to US LNG plants. We do not think all of the US LNG facilities will operate at full utilization. There will be spare capacity. But methane prices are going to remain low. If we move to refining, our refining outlook is quite positive. What we're seeing is that refining capacity additions have slowed, oil demand growth is relatively strong, and spare capacity is shrinking. The chart on the right-hand side shows seasonal demand, if you look at the lower line, for naphtha through fuel oil, and what you can see is that has a steeper growth than the additional growth in capacity. Closures that happened in Europe, in Australia, and in Japan have helped close that gap. There is a key uncertainty with the refining industry. The legislation on the sulfur content of bunker fuels is to change in 2020. It's required to go from 3.5% sulfur to 0.5% sulfur. It is the largest global sulfur reduction ever. We are not sure how this will actually work. There is a commercial incentive for the shipping industry to install scrubbers to reduce the sulfur content and enable them to continue to burn high sulfur fuel oil. But the refiners also have the opportunity to invest. They're effectively in competition. We are also not sure that the world will fully comply with this legislation. So our outlook is simply there will be less fuel oil in the shipping sector, there will be more distillate in the shipping sector, and a little bit more LNG. What that requires is refineries to run a little bit harder and the diesel gas oil price to strengthen relative to crude. So if we look at the difference between the fuel oil price and the gas oil price, we expect that differential to double by 2020. But there's much uncertainty around this legislation in terms of when it actually gets implemented and how the industry complies. So this is something we suspect will not get resolved until 2019, but it is a very important uncertainty, and at present neither the shipping industry nor the refining industry is investing to address this because of the uncertainties associated with it. In terms of a megatrend, one thing we can be sure of is when companies build new refineries, they become globally competitive. What we're showing here is our view of refinery earnings by site for refineries in Europe. Those are in the blue. And what you can see is the new projects that were in the Middle East in yellow. And you can see those projects are very, very competitive, very, very attractive. What happens is these projects are very competitive in supplying distillate fuels into Europe. They process local crude, they have very complex configurations, they've got low operating costs. Those advantages overweigh the distance of freight. And so they're actually more attractive in terms of earnings than many existing sites within Europe. So a mega trend we have is that when new refineries get built, they are very, very competitive when measured in terms of earnings per barrel. We talked about global oil demand growth slowing. This chart shows you our views if we look at it product by product. The view we have is US gasoline demand is likely to have peaked this year. So US gasoline demand as we go forwards will go down. European gasoline demand is falling. We're expecting lots of new cars, but them to be increasingly efficient. So our view is gasoline demand globally peaks before 2030 and then starts to fall. The demand for diesel continues to grow. It continues to grow in the road sector. It continues to grow in the bunker sector. The biggest source of demand growth is petrochemicals, but this puts a stress on the refining system. The demand for gasoline falls, the demand for distillate continues to grow. Those refineries that are oriented towards gasoline, we expect their competitive position to weaken as we go forwards in time. This is with a relatively limited penetration of electric vehicles. If electric vehicles are disruptive, this chart is too optimistic in terms of oil demand. We believe as a megatrend, the threat of closure for European refineries returns. We think it returns before 2025. And the reasons are on this chart. What we're showing is our view of how gasoline and our view of how balances evolve after 2022. So if you look at the charts on the bottom in light blue, that's the change in demand, change in picture for naphtha and gasoline. In the Atlantic Basin, what we're looking at is demand going down. That means there is more material available for export. In Asia, we have demand growing. And what that chart shows you is that the surpluses that are being delivered in the Atlantic Basin can satisfy the demand growth in the Pacific Basin if the trade flow works. That says no need for new refining. If you look at the same in the charts above for diesel gas oil, it shows a growing need for diesel gas oil, middle distillates, in the Pacific Basin. So our view is that refineries will continue to get built in the Middle East and in Asia. They will be built to satisfy local deficits of diesel gas oil and gasoline, but what that does is that drives closure in the Atlantic Basin. So the more refineries we get added in Asia, the more need to close in Europe and on the US East Coast. So any refining investment needs to take into account this long-term mega trend of demand in the Atlantic Basin is declining, and only the most competitive assets will survive. Moving briefly on to chemicals, the mega trend for chemicals is demand growth will continue. It is all about growing demand in the emerging economies, and that is primarily Asia, particularly China. Demand growth for olefins is growing at 5 to 6 million tonnes each and every year, which means 3 to 4 world-scale steam crackers are needed each and every year to satisfy that demand. If we look at where those are being built, what's happening in the next 4 to 5 years, you can see how things vary by region. What we're going through now is the startup of the investment wave in North America, where a significant amount of ethane-based steam cracking is coming on. We have also got we've also got new facilities being built in China, which is a mixture of steam cracking and also coal to olefins projects coming through. The competitiveness of these steam crackers is very much dependent upon crude price. So our view is that even though by end of 2021, more than 50% of global ethylene will be produced from ethane, naphtha is still the price-setting mechanism, which means crude drives ethylene price. The charts show you the difference in the shape of the cost of production curve and our view of regional pricing. But what it clearly shows is ethane cracking, LPG cracking is far more attractive at high oil prices. We expect high oil prices to return, but not quickly. That makes the decision around the next investment wave in the US challenging for those companies that are looking to continue to build. Propylene is very, very different. We are looking at significant capacity additions of propylene in China through propane dehydrogenation based on US propane. So whereas in ethylene we expect China to continue to remain deficit and to be a significant importer of the ethylene derivatives produced from the US, we're actually expecting propylene to become much more of a regional story and much more dependent upon the economics of propane dehydrogenation. If we look at general ethylene economics, the industry is still cyclical, and what we're here is just showing the degree of oversupply and undersupply as that effectively drives margins. What we're looking at now is, because of the US investment wave is being extended over 18 months to 2 years as the projects are commissioned, the amount of oversupply is relatively modest, which means we think petrochemical margins will remain reasonably strong for the next 3, 4, 5 years. The challenge becomes who builds the next investment wave? We think it'll be in the US. A lot of that will depend upon how global oil prices recover over time. So, to conclude, our outlook is crude oil prices we think will remain lower for longer, but current crude oil price levels are not sustainable. Global oil demand continues to grow, but it becomes increasingly reliant on petrochemicals as a source of growth. We think refining will have a good 4 to 5 years. We think the bunker fuel regulation could be very supportive of that, but in the long term, we think threats of closures return. And if we think of petrochemicals, demand growth is very much an Asia story for the commodity chemicals. The question is, who will build the next investment wave? Is it China naphtha-based steam crackers, or will it be US ethane-based steam crackers? With that, I'd like to thank you for your attention, and I believe we'll take questions later. Okay.